Hello everyone, I hope that you all are fit and fine, and let me tell you that I am completely fine as well. In this video, we are going to quickly revise the salary chapter for CA Intermediate Income Tax syllabus, and this will be part 1 of the video. Part 2 of the video, you will get it at the end of this video. You can just click there and see the part 2 of the video also. Now, before beginning the revision lecture, my request to you as usual is to like the video, leave a comment if you find this video helpful, and subscribe to this channel dear, because only if you subscribe you will get future updates from this channel and it will help you in your income tax preparation. And also share it with your friends as much as possible, because sharing is caring. Now let us start with the revision. So first and foremost, let us discuss the concept of salary. So salary arises only if there is employer-employee relationship. So if any amount is received by an assessee due to the employer-employee relationship, then it will be taxable under the salary head of income. Sir, what about salary to partners? Kanna, partners are nothing but part owners of the partnership firm. That is why when a partnership firm is giving salary to the partners, it will not be treated as salary, because there is no employer-employee relationship. When salary is received by partners, it will be taxable under PGBP head of income. Sir, what about salary received by member of parliament and member of legislative assembly? If member of parliament and member of legislative assembly are receiving the salary, then that is not employer-employee relationship, because they are the representatives. They only form the government. That is why when they are receiving the salary, it will be taxable under income from other sources. Now, next question. Sir, whether only full-time salary will be called as salary and part-time salary? Answer is whether it is full-time or part-time, both will be considered as salary if there is an employer-employee relationship. Okay. Sir, what about salary forgone? Sir, if I forgo my salary or if I vittu kuduttify my salary, then such salary forgone will also be taxable. So for example, if I am telling my employer that you give my salary as donation to some charitable organization, even though I did not receive the salary, still it will be taxable under my hands, because it is an application of income. You get my point? However, in certain cases, central government employees, if they are surrendering their salary, then it will not be taxable. If that special case is there, it will be mentioned in the question itself. You need not worry. Next. Sir, what about tax-free salary? Tax-free salary means what? Employer is paying the tax on the salary given to the employee. So employer himself is so nice that he is paying the tax on the salary also. Even the tax that the employer is paying is also a benefit given to the employee, and hence that will also be called as salary. However, tax paid on the non-monetary perquisites is exempt from tax. Okay. Now, sir, what about place of accrual? See, place of accrual we have already studied in residential status chapter. I told you that if a salary is received in India, it will be taxable in India as Indian income. If the salary is accruing or arising in India, then also it will be taxable in India. Then we also studied that if an Indian government is giving salary to an Indian citizen outside India, then also it will be deemed to accrue or arise in India and hence taxable in India. However, if there is any allowance or perquisite given by the Indian government to the Indian citizen outside India, then that will be completely exempt. All those provisions you have to link and then only study. Okay. Now let's talk about the charging section. The concept of salary is over. Now let us discuss charging section. Like every head of income, even salary head has a charging section and computation section. Charging section is given under section 15 and computation section is given under section 17. So what does the charging section say? Charging section says that salary is taxed on due or receipt, whichever is earlier. So if the salary is due first, then it will be taxed on due. If it is received in advance, then advance salary itself will be taxable. However, once the salary is taxable on due or receipt, later on it can again not be taxable. Hence, for only one amount, one time the assessee needs to pay the tax, double time the assessee need not pay the tax. Next. What is salary? Salary is nothing but the advance salary plus current salary plus arrears of salary. Advance salary, current salary, arrears of salary. All the three put together will be called salary. Now let us come to section 17, which is the computation section. Section 17 has three subsections. Subsection 1 speaks about salary, subsection 2 speaks about perquisites, and subsection 3 speaks about profit in lieu of salary. Firstly, let us see section 17 subsection 1, which speaks about salary. Basically, this section tells that all the different types of amounts that you are receiving from the employer will be called salary. It can be basic salary, it can be allowances, it can be retirement benefits like gratuity, provident fund, etc. So all those things are included in the salary definition. Wages, pension, all those things are included. Next, section 17.2 talks about perquisites. Now, what is perquisite, Kana? To learn perquisite better, we have to know the difference between allowance and perquisite. Firstly, let us see what is allowance. Allowance is a fixed amount given by the employer for a specific purpose. So, for example, my employer is giving me 2000 rupees per month for traveling expenses. This is called allowance. Okay, fixed amount for specific expense, and it does not matter whether I am spending the money or not. Okay, even if I'm not spending the money, still my employer is going to give me 2000 per month. This is called allowance. This is called allowance. Then what is perquisite? Perquisite is a benefit or a facility that is given to the employees. Okay, it can be in cash or it can be in kind, and perquisite will be considered only if the amount is spent by the employer or the employee, as the case may be. So it is not a fixed amount, it is a variable amount depending on what the benefit is given. So for example, if my employer is giving me a car, then it is called a perquisite. If my employer is paying the interest on my loan, then it will be called a perquisite. Like that, what and all benefits are given by the employer to the employee, it will be called as perquisite. So what is different between allowance and perquisite? Allowance will only be in cash. Perquisite can be in cash also, it can be in kind also. Allowance is a fixed amount given for specific purpose. Perquisite is not a fixed amount, it can be a variable amount. Allowance will be called as allowance whether it is spent or not spent. Still it will be called as allowance. But perquisite is called a perquisite only when it is spent or incurred. Okay. Now let us come to section 17 subsection 3, that is profit in lieu of salary. See Kana, there are 5 cases where there is profit in lieu of salary. It means all these 5 cases are generally not called as salary in the common language. However, in the Income Tax Act, it will be called as salary. So what is the first case? Compensation on termination of employment. So for example, I am telling the employee, you take 5 lakh rupees and you leave my organization. This is the compensation given for termination of employment. This is a capital receipt, but still, since it is mentioned here, it will be taxable under salary head of income. Next, compensation on modification in terms of employment. I gave you an example where I am the CEO of the company and now they want to make me the CFO of the company. So they want to bring my position down. So since they are making me the CFO, they are paying me 5 lakh rupees extra. Now this 5 lakh rupees will be called compensation in modification in terms of employment. That is also taxable under salary head of income. Next, any payment that is received from Provident fund, gratuity fund, superannuation fund or any other fund, that is also taxable under salary head of income, because even that money is coming due to the employer-employee relationship. Next, keyman insurance policy. I have told you many a times about keyman insurance policy. So when keyman insurance policy maturity amount or withdrawal is received by the assessee, if the assessee is the employee, it will be taxable under the salary head of income. If the assessee is the employer, it will be taxable under PGBP head of income. And if the assessee is other than employer or employee, it will be taxable under income from other sources. Fine. Next, any lump sum consideration or otherwise before joining the employment or after cessation of employment. So before employment or after employment, if any lump sum amount is given to the employee, then that is also called as profit in lieu of salary and it will be taxable under salary head of income. I gave you an example of joining bonus. For example, I am giving a person 10 lakh rupees so that he will come and join my organization. This 10 lakh rupees will be called profit in lieu of salary and it will be taxable under the salary head of income. Okay, now let us talk about the different types of salary. See, we have finished the charging section and we have discussed briefly about the computation section. Now let us see what and all are the items, different items that are covered in salary. Firstly, let us talk about basic salary. Basic salary means what? It is the normal salary, that means periodic payment received from the employer. So monthly what amount is received by the employer, that will be called basic salary. Next, dearness allowance. Dearness allowance. First of all, what did I tell you? Allowance means any amount of fixed amount which is received for a specific purpose. Then what is dearness allowance? Dearness allowance is an allowance received to tackle the inflation. Because over a period of time the prices of the products increase. That is why this is called inflation. Now to tackle the inflation, the employer will give an allowance. This will be called dearness allowance. This dearness allowance is there no kanna. It can be in terms or not in terms. In terms or not in terms. If dearness allowance is in terms, then generally it forms part of retirement benefits. Dearness allowance in terms forms part of retirement benefits. So in question they can give you dearness allowance in terms also, or they can tell you dearness allowance forming part of retirement benefits also. Both are one and the same. Okay, then dearness allowance can be not in terms. If it is not in terms, then generally it does not form part of retirement benefits. You get my point? Next, let us talk about fees. So if the employer is giving any fees to the employee, then if it is due to employer relationship, that also should be taxable under salary head of income. Next, let's talk about commission. There can be many types of commission that the employer is giving to the employee. However, we should differentiate the commission into two parts. First part is turnover commission. Second part is other than turnover commission. Turnover commission means what? It is a percentage of the turnover. That means if the turnover uh, done by the employee will increase, then the commission will also increase. If the turnover decreases, commission also will decrease. This is called turnover commission. And then all the remaining commission will be called other than turnover commission. Next, let's talk about bonus. See Kanna, bonus means what? It is an additional amount given to the employees, and bonus is always taxable only on receipt basis, not on due basis, only on receipt basis. Now let's talk about advance salary. Advance salary means what? Salary that is received in advance. If salary is received in advance, then it will be taxable then itself. You get my point? Because salary is taxable on due or receipt, whichever is earlier. However, you have to know the difference between advance salary and advance against salary. What did I say? Advance salary and advance against salary. Advance salary means what? Salary received in advance. Then what is advance against salary? Advance against salary means it is a loan given by the employer to the employee. But if the employee is unable to repay the loan, then such loan will be set off against the salary. This is called advance against salary. Hence, if there is advance against salary, no, that you should not add to the salary head of income. That is a loan received by the employee. So you should treat it accordingly. However, if there is advance against salary, one thing you should keep in mind. What is that? That if at all there is no interest or very less interest charge on such advance, then perquisites may arise. That we are going to learn when we are learning the perquisite concept. Okay. Next, arrears of salary. Arrears of salary. Arrears of salary means what? Salary of the past period that is received now. Okay. But if it was taxed then itself, then no need to tax it now. However, then it was, if it was not considered as income, then you consider it as income now. Fine. So what is arrears of salary? Disputed salary or retrospective salary that is received now. If it is already taxed, no need to tax now. If it is not taxed already, then you should tax now. Fine. Now let us talk about deductions. Deductions. There are three deductions, Kanna. All the three deductions are given under section 16. However, remember one point. The section 16 deductions are not allowed in the new tax regime. It is only allowed in the old tax regime. In section 16, there are three deductions, correct? One is the standard deduction of 50,000 rupees, then entertainment allowance, and the third one is professional tax. We had discussed earlier that all the three deductions were available only in the old tax regime and not under 115 BAC. But now there is a change. What change? The standard deduction will now be available to the new tax regime also. So standard deduction is allowed in both old as well as new. So firstly, what is the deduction? First deduction is standard deduction. So what is the standard deduction? 50,000 rupees or actual salary, whichever is lower. 50,000 or actual salary, whichever is lower. Next deduction is entertainment allowance. entertainment allowance is the allowance given to the employees for hospitality of the customer. So if VIP or any guest is coming, then to entertain such guest, the allowance is given. This is called entertainment allowance. Now, first and foremost, what you have to do, if entertainment allowance is received by the employee, then you should add it to the salary because it is an allowance, correct? So you should add it to the salary. After that, if it is a government employee, then you can claim deduction. If it is not a government employee, then you cannot claim deduction. But for government employee, what will be the deduction? The deduction will be lower of three amounts. The lower of three amounts. First amount is 1/5 of the basic salary. Second amount is actual entertainment allowance received. And third amount is 5,000 rupees per annum, whichever is lower. So 1/5 of basic salary, entertainment allowance actually received, or 5,000 rupees, whichever is lower, will be allowed as deduction. Now let us talk about professional tax. Kanna, what is professional tax? Professional tax is a tax on employment that is levied by the state government. Generally, it is a maximum of 2,500 rupees. Now, if professional tax is paid by the employer, then first add it to the salary and later on claim it as a deduction. Okay. However, if professional tax is directly paid by the employee, then directly claim it as deduction. No need to add to the salary. Okay. Entire professional tax can be claimed as deduction. You get my point? Now we have discussed the deduction. Now let us come to retirement benefits. The different types of retirement benefits. So first retirement benefit that we are going to discuss is gratuity. It is what? Gratuity. So what is gratuity? Gratuity is a voluntary payment that is received in appreciation for employees' services. So if employee is working for 5 years or 10 years in an organization, then the employer happily gives him a lump sum amount. This is called gratuity. But nowadays, gratuity is not voluntary. Now it has become mandatory. Okay. Now, how to tax gratuity? Let us see. Generally, gratuity should be added to the salary because it is a benefit received due to employer-employee relationship. However, exemption is available under section 10 clause 10. Exemption is available under section 10 clause 10. Now, what does 10 clause 10 say? Firstly, if at all the gratuity amount is received during service, that is during the employment period, then it is fully taxable. Then when will the exemption come? The exemption will come only if the gratuity is received on death, retirement, termination of service, resignation, and incapacitation. Death, retirement, termination, resignation, or incapacitation. Only then the gratuity will be exempt. Now, how to calculate the exemption? Firstly, you have to see whether the employee is a government employee or not a government employee. If the government employee is receiving the gratuity, then it is fully exempt. If other than government employee is receiving the gratuity, then you should see whether the employee is covered under Payment of Gratuity Act or not covered under Payment of Gratuity Act. If the employee is covered under Payment of Gratuity Act, then how to calculate the exemption? Let us see. Firstly, you have to calculate three amounts, and the lower of the three amount will be the exemption. So first amount, how to calculate? 15 divided by 26 multiplied by salary per month into number of years of service rounded off. What did I say? 15 divided by 26 into salary per month into number of years of service rounded off. Now what is this salary? Salary means basic plus DA terms. Basic salary plus DA, not DA terms. Basic salary plus DA. That is the salary definition. Okay. So 15 divided by 26 multiplied by basic salary plus dearness allowance multiplied by number of years of service rounded off. Now about this rounded off, I told you a special concept, that if there is exact 6 months, so for example 10 years and 6 months, then logically you should round off to what? You should round off to 11 years. But in Income Tax Act, if it is exactly 10 years and 6 months, then you have to do lower rounding. Lower rounding means what? You have to write it as 10 years only. However, if it is 10 years and 4 months, then what you will write? You will write it as 10 years. And if it is 10 years and 7 months, then what you will write? You will write it as 11 years. Okay. So other than exact 6 months, normal rounding will apply. But if it is exact 6 months, then you have to do lower rounding. That is the concept in the income tax law. So number of years of service you have to round off. Fine. One second. So how to calculate the gratuity exemption? If the employee is covered under Payment of Gratuity Act, then number 1, 15 divided by 26 multiplied by basic salary plus dearness allowance per month. And what salary you should take? You should take the latest salary, okay, multiplied by number of years of service, round off. So you should take the number of years of service and you should round it off. Then second amount is actual gratuity received, and third amount is 20 lakh rupees, whichever is lower. It will give you the exemption. Balance amount will be taxable. Fine. Now let us see, what if the employee is not covered under Payment of Gratuity Act? If an employee is not covered under Payment of Gratuity Act, then the exemption will be lower of the three terms. First amount is what? 1 by 2. 1 by 2 into average salary multiplied by number of years of service completed. 1 by 2 into average salary multiplied by number of years of service completed. Now here, what is salary? Here the salaried meaning changes. The salary is basic salary plus DA terms plus commission turnover. Basic salary, DA terms, commission turnover. And here you should not take the latest salary. You should take the average salary. How to find out the average? To find out the average, you have to take the 10 months preceding the month of retirement. 10 months preceding the month of retirement. So for example, if the retirement has happened on 11/11/2022, then how to calculate the 10 months? It will be from 1/1/2022 to 31/10/2022. 31/10/2022. So from the 11 you have to come to the preceding month, and the 10 months preceding the month of the retirement you have to see what is the salary received, then find out the average salary per month. So what will be the amount? The total salary that is received from January till October divided by 10. Okay, you will get the average salary. And here listen, here it is given that it is number of years of service completed. Number of years of service completed means what? One second. Number of years of services completed means what? That if there is any fraction, you should ignore the fraction. If there is any fraction, ignore the fraction. So if even if it is 10 years and 11 months, it will be considered as what? It will be considered as 10 years only, because only 10 years is completed. Fine. Now how to calculate the exemption? Let us see once again. If the employee is not covered under Payment of Gratuity Act, then number 1, find out 1 by 2 multiplied by average salary. And here salary means basic plus DA terms plus commission turnover multiplied by number of years of service completed. Okay. Second amount will be actual gratuity, and third amount will be 20 lakh rupees. Whichever is lower will be the exemption. Balance amount will be the taxable amount. Okay. Now let us discuss some special points. What are special points? If retirement gratuity is received by the members of defense, then it is completely exempt. Next, if gratuity is received from 2 or more employers, or if already some gratuity has been exempt, then already received exemption should be reduced from the limit. So what I am trying to tell, that in the entire lifetime the employee can only claim a maximum of 20 lakh rupees as exemption. So if already, let's say, he has claimed 4 lakhs as exemption, then maximum how much he can claim now? 20 minus 4, that is 16 lakhs. You get my point? Okay. Now let us discuss pension. What is pension? Pension is periodic payment received for past service. Periodic payment received for past service. Generally, pension is received in annuity form. Annuity form means what? Monthly, monthly, or quarterly, quarterly, or yearly, yearly. That is in regular intervals. However, if the pension is received in annuity form, it will be fully taxable. It will be fully taxable. Then when can we claim exemption on pension? We can claim exemption on pension only if there is commutation. Only if there is commutation. Commutation means what? If an employee gives up a part of the pension or the entire pension to receive a lump sum amount, then it is called commutation. For example, if an employee is giving up 25% of the pension of 2000 rupees per month, okay, and he is receiving how much? 30,000 rupees lump sum amount. This is called commutation. This is called commutation. So look here, if commutation of pension is there, then exemption is available under section, one second. If commutation of pension is there, then exemption is available under section 10 clause 10a. 10 clause 10a. How to calculate the exemption? Firstly, you have to see whether the employee is receiving gratuity or does not receive gratuity. If the employee is receiving gratuity, then what will be the exemption? Exemption will be full pension multiplied by 1 by 3. Full pension multiplied by 1 by 3. Sir, what is this full pension? Kanna, full pension means if you give up the entire pension amount, how much lump sum you will receive, that is called full pension. See here, in the example that I told you, if 25% of the pension is given up, 30,000 rupees is received, correct? So, if 100% is given up, how much will be received? Answer is 30,000 divided by 25%, that is 1,20,000. So, this 1,20,000 only will be called as full pension. This 1,20,000 is called full pension. So how to calculate full pension? Full pension is equal to commuted pension full pension is equal to commuted pension multiplied by commutation percentage. Commuted pension multiplied by commutation percentage. Okay, so if the employee is receiving gratuity, then exemption will be full pension into 1 by 3. If employee does not receive gratuity, then the exemption will be full pension multiplied by 1 by 2. Okay, and now let us see some special points about pension. Firstly, if any commuted pension is received from the annuity plan of LIC, that is Life Insurance Corporation, it is fully exempt. Next, if any commutation pension is received by a High Court or Supreme Court judge, then also it is fully exempt. Okay, and here be very careful. In commutation of pension, there is no concept of salary definition. While calculating, there is no concept of salary definition at all. You just have to see full pension and you have to calculate 1 by 3 or 1 by 2 as the case may be. Fine. Now let us talk about leave encashment. Leave encashment means what? Encashment of leave that is not availed. So for example, if employee is getting, let's say, 30 days per year 30 days per year as leave, but he has taken leave of only 12 days. Okay, so balance how much? Balance is 18 days leave he has not taken. Now if the employer is very happy that he has not taken leave for 18 days, so for this 18 days he is giving extra salary. This extra salary is only called leave encashment. Hence, we have to see how to treat the leave encashment. If leave encashment is received during the employment, then it is fully taxable. Now, what about retirement? If leave encashment is received on retirement, then exemption is available under section 10 clause 10AA. How to calculate the exemption? Firstly, you have to see whether it is a government employee or not. For a government employee, entire amount is fully exempt. Entire leave encashment is fully exempt. Then what about other employees? For other employees, you have to calculate the lower of 4 items. First item is what? 10 months multiplied by average salary per month. 10 months multiplied by average salary per month. Here what is the salary? Here also salary is basic salary plus dearness allowance in terms plus commission turnover. Basic plus DA terms plus commission turnover. Now here how to find the average? Generally I told you before that average means average before the month of retirement, but in this section average means average before the date of retirement. So for example, see here, and here also average is average of 10 months. Okay, so for example, if an employee is retiring on 11/11/2022, then for what period you have to find the average? From 1/11/1/2022 till 11/11/2022, that is 10 months. So see the salary received during this period and divide it by 10 months, you will find out the average. After finding the average, you have to multiply it by 10, you will get the first amount. Then what is the second amount? Second amount means leave equivalent divided by 30 multiplied by average salary. Leave equivalent multiplied by 30 divided by 30 multiplied by average salary. Now how to calculate leave equivalent? Leave equivalent is equal to earned leave minus actual leave. Earned leave minus actual leave. However, make sure that if the earned leave is above 30 days per year, then reduce it to 30 days per completed year. Reduce it to 30 days per completed year. Only maximum that much earned leave you have to take. Balance amount will be actual leave. Earned leave minus actual leave will give you leave equivalent. Then how to calculate the amount? Leave equivalent divided by 30 into average salary. Then third amount will be actual leave encashment. Fourth amount is 3 lakh rupees. You have to see whichever is lower, that will be allowed as exemption. Balance amount will be taxable.
Next change is there in leave encashment. In leave encashment, earlier the limit was 3 lakh rupees, that is in section 1010 AA. It was 3 lakh rupees. Now that limit has been increased to 25 lakh rupees. Okay.
Now let's talk about voluntary retirement scheme or VRS. VRS or voluntary retirement scheme. Now what is voluntary retirement scheme? Amount received on voluntary retirement. So an employer will tell that I am offering you 5 lakh rupees. If you want, you can take this 5 lakh rupees and voluntarily you can retire from my organization. This is called voluntary retirement. Now for the voluntary retirement, exemption is available under section 10 clause 10C. However, if the exemption has to be claimed, then the undertaking giving the voluntary retirement should be eligible undertaking and all the conditions must be satisfied. If the undertaking is not an eligible undertaking or conditions are not satisfied, then the VRS amount will be fully taxable. Okay. Now let us see what is an eligible undertaking. Eligible undertaking means generally any company, cooperative society, central government, state government, local authority, IIT, IIM, government university, etc. Then what are the conditions? Condition number 1. The employee who is receiving the voluntary retirement scheme amount should complete at least 10 years of service, or he should at least have 40 years of age. At least 10 years of service or 40 years of age. However, this condition alone is not applicable to PSU, that is public sector undertaking. Next condition, director of company or cooperative society are not eligible for exemption. Number 3, the purpose of the VRS should be overall reduction in the strength of the employees. Condition number 4, vacancy from the VRS should not be filled up. So if any employee is taking the VRS and leaving the organization, on behalf of that employee, I should not employ some other person in his post. That post should remain vacant. Then retiring employee shall not be employed in any other concern with the same management. So if an employee is taking the VRS amount and leaving the organization, I should not hire him in any other organization also where I am doing the management. Okay. Next, only up to the prescribed limits. This prescribed limits only we are going to learn now. So all these conditions only if they are satisfied, only then exemption is available under VRS scheme. Okay, that is 1010C. However, if in questions it is not clear whether the undertaking is an eligible undertaking or whether the conditions are satisfied or not, then you assume that the undertaking is eligible and conditions are satisfied and you do the calculation. Okay, so how to do the calculation? You have to calculate 4 amounts. Out of the 4, whichever is lower will be the exemption, balance amount will be taxable. So first amount will be what? Salary per month multiplied by 3 months multiplied by number of years of service completed. So what is the salary? Here also salary means basic salary plus DA terms plus commission turnover. So what is it? Basic salary plus DA terms plus commission turnover. It is the salary per month. You have to take multiply into 3 months multiplied by number of years of service completed. Next, second amount how to calculate? Salary, that is basic salary plus DA terms plus commission turnover multiplied by balance months of the service left. Then number third one is actual VRS, or number 5, 5 lakh rupees, whichever is lower. So whichever is lower will be exempt, balance amount will be taxable. Now listen carefully. VRS exemption is a once in a lifetime exemption. So if once an employee has claimed the VRS exemption earlier, it will not be allowed once again. Now let us talk about retrenchment compensation. Retrenchment means what? Compulsorily, it is the reduction in the number of employees. The employees are not getting the choice. They are asked to leave the organization forcefully. Since the employees are leaving the organization forcefully, there is an act called Industrial Disputes Act of 1947, and that act tells that the employer must give a compensation to the employee. Hence, for this compensation that is received by the employee, exemption is available under section 10 clause 10b. How to calculate the exemption? Number 1, compensation as per the Industrial Disputes Act. Number 2, actual compensation received by the employer. Or number 3, 5 lakh rupees, whichever is lower will be exempt, balance amount will be taxable. Okay. Now let us talk about Provident Fund. Provident Fund. So what there are four types of Provident Fund, Kanna. First Provident Fund is recognized Provident Fund, then unrecognized Provident Fund, third one is statutory Provident Fund, and fourth one is public Provident Fund. Sir, what is recognized Provident Fund? Recognized Provident Fund means a Provident Fund that has satisfied the conditions that are given in Employee Provident Fund and Miscellaneous Provisions Act of 1952, and the Income Tax Commissioner has given recognition. Income Tax Commissioner has given recognition. Then what is unrecognized Provident Fund? A Provident Fund that is not recognized by Income Tax Commissioner. Then what is Statutory Provident Fund? Statutory Provident Fund is a Provident Fund which is governed by the Provident Fund Act of 1925, and generally it applies to government employees. So where the government employees are there, they are depositing their amount in the statutory provident fund. Next, what is public provident fund? Public provident fund is a provident fund for the people who are not the employees. It is for self-employed people. So where there is no employer-employee relationship, there public provident fund will arise. So let's say I am not an employee of an organization, still I can contribute my money in public provident fund. It is governed by Public Provident Fund Act of 1968. Okay. Now what is superannuation fund? Superannuation fund is also a retirement benefit like a provident fund only. Superannuation fund also can be approved or unapproved. Approved means what? It is approved by Income Tax Commissioner. Unapproved means it is not approved by Income Tax Commissioner. Now all these funds are there. No, let us see how to treat these funds. First and foremost, let us discuss about different parts. What are the parts that we are going to discuss? Firstly, we are going to discuss about employer contribution, then we will discuss employee contribution, then interest received during in the fund, and then maturity amount. Maturity means what? The withdrawal from the fund. Okay, so firstly let us talk about statutory provident fund. In a statutory provident fund, when the employer is contributing, then the entire contribution is fully exempt but subject to section 17 to 7. Subject to section 17 to 7. What is 17 to 7? We are going to learn in a little while. Okay, so employer contribution fully exempt, then employee contribution you have to ignore. Why to ignore employee contribution? Because see Kanna, when employee is giving contribution to the fund, he is giving from his own pocket, so it is not an income. That is why you ignore the amount, because it is application of income. However, there is a section called section 80C that we are going to learn in the deduction chapter. There we will learn that in section number 80C, the employee contribution is allowed as deduction. Fine. Next, let's talk about interest. So if any interest is credited in the statutory provident fund, it is fully exempt, and even the maturity amount is fully exempt under section 10 clause 11. Section 10 clause 11. But this is also subject to another section that we are going to learn in some time. So now let us talk about recognized provident fund. In recognized provident fund, no Kanna, the employer contribution is there, no, up to 12% of the salary it is exempt. More than 12% of the salary if it goes, then the excess amount will be taxable in that year itself as taxable perquisites. In that year itself as taxable perquisites. Now what is salary? Salary here also it means basic salary plus DA terms plus commission turnover. Basic salary, DA terms, commission turnover. Okay, so up to 12% of the salary exempt. More than 12% means what? The excess amount is going to be taxable, and this also exemption is subject to section 17 to 7, which we are going to learn in some time. Now what about employee contribution? Employee contribution you should ignore because it is an application of income. However, deduction can be claimed for employee contribution under section 80C. Okay. Next, if the interest is up to 9.5% per annum, it is fully exempt. However, if it is above 9.5% per annum, it will be taxable. Okay, during that year itself. Next, maturity amount is also exempt under section 10 clause 12. However, there is a condition. There is a condition. Recognized provident fund maturity will be exempt only if the employee is a member of that recognized provident fund at least for 5 years. At least for how many years? 5 years. If within 5 years if the amount is withdrawn, then it will be fully taxable, and even that recognized provident fund will deduct the TDS that you should link in TDS chapter. They will deduct the TDS and balance amount only they will pay to the employee. Okay. Now, for this 5-year rule, no, there are certain exceptions. It means if the employee is covered in the exception, then he need not see that 5-year rule. It will still be exempt. So what are the exception? Number one, if the funds are transferred from the old employer's recognized provident fund to new employer's recognized provident fund, then you need not see the 5-year rule. If the amount is transferred from old employer's recognized provident fund to the new employer's NPS, that is National Pension Scheme under section 80 CCD, then also you need not see this 5-year rule. And second part, if any of the three conditions are satisfied, then also you need not see the 5-year rule. What are the three conditions? Number one, due to ill health. If due to ill health of the employee, if the employee has to leave the organization. Number two, if due to discontinuance of employer's business, he is withdrawing the money from the recognized provident fund. And number three, due to any other reason beyond the control of the employee, if he is receiving the money from the recognized provident fund. In such case, you need not consider the 5-year rule. Even if the withdrawal is within 5 years, it will be fully exempt. Okay, but other than these conditions, you have to see the 5-year rule. If it is within 5 years, it will be exempt. It will be taxable. If it is after 5 years, it will be exempt. Okay. Now, let us talk about unrecognized provident fund. In unrecognized provident fund, if employer is contributing, it is not taxable. If employee is contributing, you have to ignore since it is application of income. And unrecognized provident fund is there, no? In that, if employee is contributing, then also he will not get the deduction under ATC since it is unrecognized. Next, interest also is not taxable. However, maturity amount is taxable. The maturity amount or the withdrawal amount, you have to divide it into 4 parts. What are the 4 parts? Employer contribution, employee contribution, interest on employer contribution, and interest on employee contribution. Now, listen, employer contribution and interest on employer contribution will be taxable under the salary head of income in the year of maturity or in the year of withdrawal. Then employee contribution will not be taxed because it is an application of income. And then interest on employee contribution will be taxed under income from other sources head of income. You get my point? Now, listen, even for recognized provident fund, if the 5-year rule is not satisfied and also if the assessee is not there in the any of the conditions, then what will happen? I told you that the amount will be taxable. How to tax the amount? The amount is taxable just like the unrecognized provident fund. Recognized provident fund amount will be taxable just like the unrecognized provident fund if the 5-year rule is not followed. You get my point? However, if any amount is already taxed, it will not be taxed once again. Okay. Next, public provident fund. See, in public provident fund, no kana, employer contribution will not apply at all because there is no concept of employer-employee relationship for PPF. Next, what about employee contribution? See, if I am contributing to the public provident fund, then you have to ignore the contribution since it is an application of income. However, I can claim a deduction under section 80C. Next, interest on PPF is fully exempt and maturity amount is also fully exempt from tax. Now let us talk about approved superannuation fund. In approved superannuation fund also, the employer contribution is fully exempt subject to section 17 to 7, which we are going to learn in some time. Then employee contribution you can ignore. Interest on employer contribution or employee contribution is fully exempt and even maturity amount is exempt under section 10 clause 13. Then unapproved superannuation fund is taxable the same as unrecognized provident fund. So for both of them you have to treat the same way. You get my point? Sir, now let us talk about section 17 to 7. What does section 17 to 7 say? The section 17 to 7 says that aggregate of the amount of employer contribution to any of the following funds in excess of 7.5 lakh rupees will be considered as perquisite. So if employer is contributing more than 7.5 lakh rupees to recognized provident fund, NPS, that is National Pension Scheme or New Pension Scheme, or new pension system trust, whatever the name may be, if it is contributed or approved superannuation fund, then if the total amount is more than 7.5 lakhs, it will be taxable. Greater than 7.5 lakhs, it will be taxable. What will be the taxable? Excess amount will be taxable, Kanna. What will be taxable? Excess amount will be taxable. One second. Excess amount will be taxable. So for example, if the employer is contributing, listen here, if the employer is contributing 5 lakh rupees to recognized provident fund and then 5 lakh rupees to approved superannuation fund, then both of them together is how much? 10 lakh rupees. It is 10 lakh rupees. Is 10 lakh greater than 7.5 lakhs? Answer is yes. So the balance amount, that is 2.5 lakhs, will be taxable. This will be taxable. Okay, so if amount or aggregate of amount in recognized provident fund, NPS under section 80 CCD, and number 3 approved superannuation fund, if it is exceeding 7.5 lakh rupees, then the excess amount will be taxable during the year. Okay, and not only this, the interest that is received on this excess amount is there, no, this 2.5 lakh rupees. On this 2.5 lakh rupees, if any income is received, if any income is received, one second, then such income also will be taxable. Now how to calculate the income? See Kanna, in section 17 to 7a it is given that on such amount, that is amount over 7.5 lakh rupees, whatever income is received, that also will be taxable. Now how to calculate that income? How to calculate that income? Let us see. To calculate that income, the Income Tax Act has given you formula. What is the formula? Formula is given under Rule 3B. Rule 3B. So what is the formula? TB is equal to PC divided by 2 multiplied by R into, plus PC1 plus TP1 multiplied by R. What did I say? TP. What is TP, Kanna? TP means taxable perquisite. TP means taxable perquisite. What is PC? PC means contribution. Okay, this PC means contribution during the year, contribution during the previous year, which is in excess of 7.5 lakh rupees. PC means what? Contribution during the previous year, that is in excess of 7.5 lakh rupees. Then what is PC1? PC1 is the contribution in excess of 7.5 lakh rupees in all the previous years on or after 1/4/2020. PC1 means what? The contribution to the funds. What are the funds? The recognized provident fund, approved superannuation fund, and NPS. In all these three funds, if the contribution is more than 7.5 lakh rupees in all the preceding previous years on or after 1/4/2020, then it will be called as PC1. It will be called as PC1. Then what is TP1? TP1 will be the taxable perquisites of all the preceding previous years that would have been calculated. Now what is R? R is equal to I divided by F average. I divided by F average. Now what is I? I means income. I means income. Income from all the three funds during the previous year. I means income from all the three funds during the previous year. Then what is F average? F average means what? Fund average. F average means fund average. Fund average means opening balance of all the three funds combined plus closing balance of all the three funds combined divided by 2. F average means what? Opening balance of all the three funds combined. What are the three funds? Recognized Provident Fund, NPS, and approved superannuation fund. All the three funds combined, what is the opening balance plus closing balance divided by 2. Like that you have to find the F average. So now let me repeat the formula. How to calculate the taxable perquisite? Taxable perquisite is equal to PC divided by 2 multiplied by R plus PC1 plus TP1 multiplied by R. Okay, like this you have to find out the taxable perquisite. If you are solving one question that is there in the study material relating to this concept, you will be even more clear. Okay, now let us talk about one more section. And what is the section? Now this section relates to employee contribution. First we were talking about employer contribution that is more than 7.5 lakh rupees. Now there is one more section which talks about employee contribution, and it says that if the employee is contributing in the provident fund, if the employee is contributing in the provident fund and if the employee contribution is more than 2.5 lakh rupees, then the amount that is more than 2.5 lakh rupees, no, on that whatever income is received, that will be taxable. So listen here, if at all an employee is there, okay, an employee is contributing 4 lakh rupees, 4 lakh rupees to provident fund. This is called employee contribution. Can employee contribution be taxable? Never. Employee contribution will never be taxable because it is an application of income. Now what am I talking about? I am talking about the interest on employee contribution. So listen here, on this 4 lakh rupees, okay, on the first 2.5 lakh rupees you will receive an interest, and the balance 1.5 lakh rupees you will receive an interest. On the first 2.5 lakh rupees, whatever you receive as interest will be exempt, which we have already studied. Then on the balance 1.5 lakh rupees, whatever interest is received, that will be taxable. That will be taxable as perquisites. Okay, it will be taxable. So now, so what did I tell? If the employee is contributing more than 2.5 lakh rupees to a provident fund, then income on such excess contribution will be taxable. However, this limit of 2.5 lakh rupees will become 5 lakh rupees if there is no employer contribution. So listen here, in this example that I told you, I am assuming that there is some employer contribution. If in the same example, if the employer is not contributing any money, then the limit will become how much? The limit will become 5 lakhs. In such case, this entire 4 lakhs is there, no? On this, the income will be exempt since it is within 5 lakhs. So what did I tell? See, listen one more time, very important provision. If the employee is contributing more than 2.5 lakh rupees, then income on such employee contribution will be taxable. However, if there is no employer contribution, then this limit of 2.5 lakh rupees will become how much? It will become 5 lakh rupees. It will become 5 lakh rupees. And this provision has been applicable from 1/4/2021. From 1/4/2021. Before this, entire amount used to be exempt, but from 1/4/2021 it is taxable. So now the employee has to maintain two accounts. What are the two accounts? Taxable contribution account and non-taxable contribution account. In taxable contribution account, what and all will come? From 1/4/2021 onwards, whatever is the employee contribution that is more than 2.5 lakhs or 5 lakhs as the case may be, that will be coming under taxable contribution account, and interest on such amount also will be coming under taxable contribution amount. Then whatever is the balance amount will be coming under non-taxable contribution account. So this is taxable and non-taxable contribution account as per rule 9D. So employee should start maintaining both these accounts from previous year 21-22 onwards for the employee contribution. So I hope you are clear with the provident fund concept. And even this provident fund concept, you have to be very thorough because it will be linked even with the deduction chapter, that is under section 80C, and also 80CCD, the new pension scheme that you are learning. And then in PGBP also we have learned from the employer point of view that what and all amount the employer is paying will also be allowed as deduction subject to certain rules and conditions that are given in the PGBP chapter. So I hope you are clear with all the retirement benefits. You are clear. Now let us talk about allowances. Now let us talk about allowances. So in allowances there, Nokana, what did I tell you? Allowance means a fixed amount received for a specific purpose. Now in allowances there are three types of allowance: fully exempt allowance, partly exempt allowance, and fully taxable allowance. Now fully exempt allowance means what? First and foremost, any allowance given to High Court or Supreme Court judge will be fully exempt. Then sumptuary allowance given to High Court or Supreme Court judge will be fully exempt. Then Compensatory allowance given to judge as per Article 222 of the Constitution will be fully exempt. Then any allowance, salary or perquisite, whatever, if it is given by United Nations organization, that will be completely exempt. Then section 10 clause 7 says that if perquisites and allowances are given by an Indian government to an Indian citizen outside India, then it is fully exempt. And then if some specific allowances are given to present or retired members of the UPSC, then also it is fully exempt. Then what about taxable allowances? See Kana, we are going to learn about fully exempt and partly exempt allowances. All the remaining allowances will be fully taxable. Hence, I am not discussing fully taxable allowances. Now let us discuss partly exempt allowance. Partly exempt allowance is given under section 10 clause 14 and 10 clause 13a. First, let us discuss section 10 clause 13a. Section 10 clause 13a discusses about house rent allowance, that is HRA. However, remember one point, section 1013a, that is house rent allowance exemption, it is not allowed to an employee who is choosing section 115 BAC. So in new tax regime, this exemption is not allowed. Now let us talk about what about the old tax regime? The old tax regime can claim exemption under section 10 clause 13a. How to calculate the exemption? Number 1, 40% or 50% of the salary. 40% or 50% of the salary. 40% in case of non-metro city, 50% in case of metro city. What is metro city? Mumbai, Delhi, Chennai, Kolkata. Okay. Then how to calculate the salary? See here also salary means basic salary plus DA terms plus commission turnover. Basic salary, DA terms and commission turnover. And for what period you have to take the salary, Kanna? You have to take for the period for which the employee is staying in that rented accommodation. The period for which employee is staying in the rented accommodation. Then second amount will be actual HRA received, and third amount will be rent paid minus 10% of the salary. Then you have to see whichever is lower, it will be allowed as exemption. Balance amount will be taxable. Okay. Now let us come to section 10 clause 14. In section 10 clause 14, firstly let us discuss section 10 clause 14 subsection subclause 1. Section 10 clause 14 subclause 1 tells that any allowance that is received, okay, if the amount is spent for official purpose, then whatever amount is spent for official purpose will be fully exempt. Whatever amount spent for official purpose will be fully exempt. So for example, if I am getting an allowance of 10,000 rupees and 8,000 rupees I have spent for official purpose, then 8,000 will be exempt, balance 2,000 will be taxable. Now what are the allowances covered in this section? Let us see. Firstly is conveyance allowance. Conveyance allowance. Conveyance allowance means what? Within the city, if I am traveling, then it is called conveyance. Allowance received for conveyance is called conveyance allowance. Next, uniform allowance. Uniform allowance is the allowance given to stitch uniform. Number 3, research allowance. Research allowance is an allowance given by educational or research institution for research or training purposes. So amount received for research or training will be called research allowance. Next, daily allowance. Daily allowance means what? If I am going out of town, if that out of town, if I am spending for food and stay etc., for that whatever allowance that I am getting, it is called daily allowance. Then helper allowance. Helper allowance means if my employer is giving me allowance to keep a helper, and this helper should only be for official work, okay, then such allowance is called helper allowance. And then last one is traveling allowance. Traveling allowance means if I am traveling from one city to another city, for that travel ticket, if I am getting an allowance, then such allowance is called traveling allowance. So what are the 6 allowances? Conveyance allowance, uniform allowance, research allowance, daily allowance, helper allowance and travel allowance. All these 6 allowances, if I am spending for official purpose, entire amount spent will be allowed as exemption, balance amount will be taxable. Balance will be taxable. Okay. Next, let us talk about section 10 clause 14 subclause 2. See, in section 10 clause 14 subclause 2 Nokana, there is a minor difference. What is the difference? Here, the exemption does not depend on whether you are spending the money or not spending the money. It is dependent on the limit. Okay, it is dependent on the limit. So, how much ever limit is there, that much exemption will be given. If the income is above the limit, then the balance amount will be taxable. See, for example, if I am getting tribal area, scheduled area or agency area allowance, then limit is what? 200 per month. So if I'm getting an allowance of 500 per month, if let's say I'm getting an allowance of 500 per month, then if I'm getting an allowance of 500 per month, then 200 will be exempt and balance 300 will be taxable. 200 will be exempt, balance 300 will be taxable. You get my point. Next, transport system allowance. Transport system allowance means what? It is a daily allowance given to transport system employees. Who are transport system employees? An employee who is working in the transport system like bus or trucks or railways, etc., etc. If the employees are working in transport system, they will receive transport system allowance. The transport system allowance, how to calculate the exemption? Exemption is 70% of the allowance or 10,000 per month, whichever is lower. Balance amount will be taxable. Okay. However, remember one point, if a transport system employee is receiving daily allowance also, in such case transport system allowance will not be exempt. Okay. Next, let's talk about transport allowance. What is transport allowance? Transport allowance is the allowance given for traveling from home to workplace, workplace to home. Home to workplace, workplace to home. This exemption is only given to specially abled people. Who are the specially abled people? Blind, deaf, dumb and handicapped. Blind, deaf, dumb and handicapped people get the benefit of exemption of rupees 3200 per month. Maximum how much? 3200 per month. All the others, it is fully taxable. Okay. Now let's talk about underground allowance. Means allowance given for the employees for going underground. For example, in mining, etc. So the allowance is 800 rupees per month. Exemption is 800 per month. If it is more than 800, excess amount is going to be taxable. Next, children education allowance. It is an allowance given for the education of the child of the employee. It is exempt up to 100 per month per child, maximum 2 children. Next, hostel allowance for children is exempt for up to 300 per month per child, maximum 2 children. Now let's talk about hilly area allowance. Hilly area allowance is a allowance given based for the hilly area, hilly regions, and it depends on the hilly region how much allowance is given. Now let's talk about the allowances for given to the armed forces like the Army, Navy, Air Force, CRPF, etc., etc. If they are getting island duty allowance, that means going to island and doing the duty, then maximum 3250 per month is exempt. Next, high altitude allowance. If the armed forces are going to a high altitude and doing the duty, for example Ladakh, etc., then if the height is within 9000 to 15,000 feet above sea level, then 1060 per month will be the exemption, maximum exemption. And if the height is above 15,000 feet, then the maximum exemption will be 1600 rupees per month. Next, if the armed forces is receiving border area, remote area or disturbed area allowance also, then also depending on the area, exemption can be claimed. Next, compensatory field area allowance. Compensatory field area allowance exemption is given up to 2600 rupees per month. For compensatory modified field area allowance, exemption given is up to 1000 rupees per month. For special compensatory highly active field area allowance, okay, the compensation is up to, the exemption is up to 4200 rupees per month. For counter insurgency allowance, the exemption is up to 3900 rupees per month. So all these limits are there, and this compensatory modified, special compensatory and counter insurgency allowance, for all these four allowances, that is the last four allowances, exemption is not available if border area allowance is claimed as exemption. If border area allowance is claimed as exemption. So these are the exemptions that are there in section 14, section 10, clause 14, subclause 2. Now let's talk about a special point. In the new tax regime under section 115 BAC, all these allowances under section 10 clause 14 are not allowed. However, four allowances are still allowed. What are the four allowances? Daily allowance, conveyance allowance, traveling allowance and transport allowance. Daily allowance, conveyance allowance, traveling allowance and transport allowance are applicable or are exempt for new tax also, old tax also. For both of them, exemption can be claimed. All the remaining allowances, exemption can be claimed only if the employee is choosing old tax For the new tax under 115 BAC, it is not applicable. So I hope you are clear with the allowances. So we have discussed so many concepts in this video: concept of salary, charging section, okay, computation section. Then we discussed the different types of salary. Then we discussed the deductions, retirement benefits, and also the allowances. I hope you are clear with the concept. The perquisites part and the remaining concept we will discuss in part number 2. So see you in part number 2, dear. Keep learning, keep revising. Take care. Bye bye.